Welcome to Inside India. This is Friday. Happy Friday. I'm Amitod Singh, and these are your headlines. We are counting down to the BOJ decision. It's widely expected to lift rates only for the second time this year as inflation stays well above its target. We're also following one of India's largest IPOs of the year, ICICI Prudential Assets, 1.2 billion listing set to hit the markets today after a strong subscription period. Shares in the grey market indicating a strong open. And India signs a trade pact with Oman, diversifying its trade ties in the face of steep US tariffs. All right, let's kick things off with a look at how markets are trading in APAC. APAC markets rising Friday with all eyes on the Bank of Japan's decision. Take a look at that. It's really almost a carpet of green, except for Philippines and Jakarta. But remember, we are going to be focusing on a decision that's coming from the Bank of Japan any minute now. Analysts suggesting a rate hike of 0.25. That's already priced in, they suggest. Also, this morning's government data of Japan's consumer inflation rate dropped to 2.9% in November. That's also feeding into the market sentiment. This follows U.S. markets, the S&P 500 snapping a 4-day slide on Thursday after inflation data of their own was lighter than expected, suggesting lower interest rates in 2026. Now, the U.S. market getting momentum from the other big mover, chip maker Micron Technology. That stock jumped 10% after the company signaled robust demand for its memory chips and blew away fiscal first quarter estimates. We're watching how this develops, but at this point in time, Japan in focus. And take a look at the Nikkei. It's up 1.16%. Now, as we were talking about Japan, ahead of the Bank of Japan decision, the BOJ is widely expected to hike by 25 basis points, bringing rates to a 30-year high. It would be only their second hike this year since January when they started normalizing borrowing costs. Now, data this morning boosting the case for a hike. Japan's core inflation print holding steady at 3%, but still well above the BOJ's 2% target. The yen ahead of that looking like this at 155, still a bit weakened compared to the US dollar. That is a percentage of 0.21%. 0.2%. Now, the Indian markets, they're coming online in about 45 minutes. GIFT Nifty futures, what are they indicating? Nifty, remember, it ended largely flat on Thursday. It was up, it was down, and then flat, not finding that clear direction after 3 consecutive sessions of losses. It's stocks, the IT stocks really, they climbed 1.2%, making them the strongest performing sector of that session. Now, in today's session, what we're seeing is the indication that we're going to jump about 150 points, 140 points really. 25,955 is what GIFT Nifty futures is pointing. Nifty 50, remember, closing at 25,815. Now, some of the things that we're watching out for today, the shares of Meesho, Ola Electric, Bharti Airtel, JSW Energy, and Vodafone Idea, among others, are expected to have some developments, company-specific developments. And the Indian rupee, really, that's where the focus has been for a while. It's posted a modest advance on Thursday. Whether it was RBI intervention or not is something that would be in the realm of speculation, but ending at 90.24 to the dollar, about 1.1% stronger than the previous session. There's a lot to catch up on at this point in time, the rupee at 90.20. Now, there's also going to be a new market joiner this morning, ICICI Prudential Asset Management. It's a 1.2 billion share sale, heavily oversubscribed. In fact, with 33 billion in bids. It's the 4th most subscribed IPO in India. The company is India's 2nd largest asset manager, a joint venture between ICICI Bank and British insurer Prudential. The debut caps off a record year of fundraising on the Indian bourses. We're watching that, and we'll continue to track that very closely. Now, we want to shift to what Prime Minister Modi's been up to. His latest visit to Oman, it wrapped up with the two countries signing a comprehensive economic partnership agreement. This was on the cards, and as India seeks to expand its ties with the Middle East, it has been, in focus. Oman has offered India zero duty access on over 98% of its tariff lines, covering nearly all Indian exports. In turn, New Delhi has offered to cut about 78% of its tariff lines, covering most imports from Oman. The pact marks Oman's first bilateral agreement in almost 20 years, its last deal being with the US in 2006. Now, the partnership, the India-Oman partnership, gives India a stronger strategic foothold near the Strait of Hormuz, a major transit point for global oil. News just in this morning also and this is big news, it was in the making earlier yesterday, the European Union reaching a breakthrough on a financial lifeline for Ukraine. The bloc agreed to provide Ukraine 90 billion euros or $105 billion in support, covering 2/3 of its financing needs for the next 2 years. The decision was announced just about an hour ago after a late meeting that ran through to early Friday morning. This was expected. It was going to be intensive discussions. This was Brussels time, of course. The financial support will come from borrowed cash secured against the EU budget. Hungary, Slovakia, and the Czech Republic have been excluded from guarantees for the debt. Ukraine will only need to repay the loan after it receives war reparations from Moscow, if at all that happens. In the meantime, a draft text shows the EU is still working on a separate loan for Ukraine, funded from profits on frozen Russian assets. A lot happening. Let's take a quick look at oil prices and how they have shifted. The benchmark WTI at this point in time at 56. That's interesting. And the ICE Brent crude still inching closer and staying around that 60 barrier at 59.66, the price action, but mostly flat today. After what's really been a very volatile year, both benchmarks have fallen around 20% year to date and headed towards 5-year lows. A lot of that has been due to resilient supply as OPEC hikes output, creating concerns around oversupply in the market. Traders also anticipating news of an end to that Russia-Ukraine war when the US and Russian officials meet in Miami just this weekend, which could mean an end to energy-related sanctions, bringing a lot more Russian energy back into the market. All right, a lot to cover, that and more with Mohit Soni. He's the Director of Asia Pacific Corporates at Fitch Ratings. Mohit, thanks so much for joining us. I don't know where to start because there have been developments even in India with new rules in the PNG sector that the Modi government notified a couple of days ago. But I want to start very quickly on your overview of this development that's come in from the EU and what it suggests to you for the general oil market.
Sure, Amit. So thanks for having me on your show. I think in terms of the overall crude oil market, we do actually expect prices to remain at around $63 a barrel over the next few years. If we just look at the market very, very fundamentally, I think there is still a lot of spare capacity with OPEC Plus, which they are looking at bringing on stream. And in terms of new supply growth, the supply growth is also expected to outpace demand growth by quite a bit of margin over the next couple of years. So I think while some of these developments may impact crude prices in the near term, but longer term, our view is prices will stabilize at around $63 for the next few years and later on fall to around $60 as some of the energy transition risks also start to materialize.
All right. Let me just get back to India and how all of this plays out with India changing its rules, notifying these new rules from 1959 and now to these new rules, the petroleum and natural gas rules recently approved. A couple of basic things for our viewers to understand that this replaces the earlier system of multiple licenses. And now there's a single petroleum lease, which covers exploration, development, and production of all hydrocarbons, including shale. So let's just start with that aspect. Do you see this getting implemented smoothly, or will there be hiccups, and this will take a long time to actually get implemented to see results?
Sure. I think, see, the point that you raised about licensing timeline being extended, there are a few points in the new law which actually I think give a lot of comfort around licensing certainty and the timelines as well. I think first, as you were briefly mentioning, that the lease term has now been extended for up to 30 years and extendable even beyond that. It's obviously much longer than earlier, which used to be around 8 to 10 years. And the government also had the option of canceling leases due to a variety of reasons. So this obviously gives a lot more and a longer time period visibility to investors on the period over which they can generate their returns. So I think that is positive. Second, that it covers the entire breadth of activities like you mentioned, from exploration to development to production, and even now actually integrating renewable projects within the oil field. So that is simplifying the whole process, and that will improve the ease of doing business. And third, I think, is the fact that the time limit on the approvals has been mandated at 180 days. So I think that also adds visibility to how fast you can actually start your business, because that has been a key issue. And I think there are a few very famous cases where, approval has been delayed for a number of years for something as simple as not knowing what is the lease value based on which stamp duty should be calculated. So I think some of these, developments are positive. To your question on whether there will be, execution risks, I guess, as is the case for most reforms of such nature, there will be definitely execution risks. I think it remains to be seen whether approvals will actually come in 180 days or not. Sometimes these policy wordings can be interpreted differently by different parties, so that can lead to some kind of litigation issues. I think the law itself can evolve over a period of time through an iterative process where industry players can give feedback which the government would consider. And there's always the case of bureaucratic inertia in India. So I think those risks remain, but it definitely seems to be a step in the right direction.
You were referring to a particular famous case without mentioning it, and that's in the eastern state of West Bengal, Ashoknagar. That was a prime example of why there have been problems with India's PNG rules. This, for our viewers, was something regarding ONGC, the Oil and Natural Gas Corporation of India, striking its first commercial crude oil discovery. This was in 2018, but all the way for many years, even up till now, things couldn't move forward because there was a dispute with the West Bengal, the state government. And this is meant to make things easier for clarity on biggest dispute, which was the value of the lease on which stamp duty should be paid. Now, my larger question to you about this is that that's been 7 years in the making. India's crude production fell by about 3% in FY 2025. Despite capital expenditure more than doubling to 62,000 crore, which is, well, we'll translate that for you in a bit. Yes, the government has rolled out these several policy reforms over the years, but it's not made that impact. And I know you have talked about government inertia, that everyone seems to start to understand about India. But at the end of the day, why is this any different? Why will this promise that kind of change fast? It will do it in the long term, but why will it do it immediately?
That's a good question, Amitoj. And to be honest, I think if we are talking about the immediate term impact, I do think it can be positive for investments coming in, because such a dense regulatory framework is now being simplified. There are steps being taken which will provide greater visibility on operational and economic stability. For instance, there is a new stabilization clause which has been introduced, which will protect existing lessees from any future changes in royalties, taxes, etc. Or the fact that international arbitration has now been allowed for corporates that are incorporated outside, which can possibly again give them confidence. Because as you know, India has had 100% FDI allowed in upstream sector for a long time, but we've not seen too much. And possibly the arbitration reason was one of them. So I think with these issues being addressed, investment should pick up. But you're right. I think in terms of production numbers, it will take a lot of time, just simply because E&P by itself is a very long gestation period kind of business, right from geological surveys to exploration, production, etc. It can take a number of years. And like you rightly mentioned, India's crude oil import dependency has increased from 78% 10 years back to about 88% now. So we also have a reserves problem, and the laws are not going to magically, reduce India's import oil dependency overnight. But yes, at the margin and gradually, production should increase. And I think this is something we've also seen numerous examples of in other Southeast Asian countries, wherever national oil companies have tied up with global oil and gas majors. They have seen increases in their production level, benefiting from their better technical know-how and expertise.
Right. Yeah, so that was 62,000 crore translates to 620 billion rupees. I wanted to double check my math on that. I guess the question here is then very simple. Could the government have done any more? That's the question.
I think we can always do more. So they could have done this earlier. They could have done more even now. But like I said earlier, I think this will be an iterative process, something we also saw with the IBC when it was implemented, and as industry gave feedback, the government was willing to sort of improve on its first draft. So I think the good thing at least is that overall the government seems receptive to receiving the right feedback and improving upon their first efforts.
All right. I want to get in the discussion around the trade deal between Oman and India. It gives access to the Strait of Hormuz to India, and that's incredibly important. That's understandable. Now, India and Oman have had close relationships for a long time. This is an interesting development because one thing that it does is, and this is in the context of, let me put it this way, the rupee is getting weaker. India is paying more for imports. Could this deal in any way, how do you see this deal, but could this deal in any way also make India look for cheaper oil from Russia or other alternative suppliers? How do you see this all playing out?
At least with regards to just the Oman deal, I have not sort of looked at it very, very specifically. But I think in terms of India's overall strategy to import cheap crude, I think that remains intact. And the oil marketing companies have very clearly articulated their intent that the mandate for them is to source the cheapest and most economically viable crude. I think that's one of the reasons why Russian imports have obviously increased so significantly in recent years, because Russian noodles trade at a discount to Brent. And I think wherever India finds cheaper options, they will look for them. We have quite a diversified basket of almost 30 to 35 countries from whom we import. And anyway, like I mentioned earlier, it's not like supply is constrained in the overall market. There's a lot of ample new supply coming in. So from that perspective, I don't think the oil prices or availability of oil itself will be too much of a challenge.
All right, Mohit Soni from Fitch Ratings, thanks so much for giving us all that perspective on the new PNG rules in India and the trade deal between Oman and India. Appreciate that very much. All right, latest developments coming in. Protests reigniting in Bangladesh overnight over the death of a prominent youth leader involved in the country's pro-democracy uprising that ousted former Prime Minister Sheikh Hasina last year. The 32-year-old Sharif Osman Hadi was shot at by masked attackers last week and was receiving emergency medical treatment here in Singapore. He was pronounced dead yesterday. Hundreds of his supporters gathered in the capital city of Dhaka to protest, calling for the arrest of his killers. Hadi had intended to run as an independent candidate in Bangladesh's upcoming elections. Now we'll continue to keep track of that escalating situation in Dhaka. Inside India is taking a short break. We'll be back in just 2. All right, the Bank of Japan's decision just crossing the wires, and what we know for sure is that the Bank of Japan has raised short-term interest rate target to 0.75. It has also raised its rate to 0.75, as was expected. More than 80% of those who were polled suggested that that's exactly what's happened. This policy decision has been made unanimously. It's a unanimous vote, and it has raised that, just to repeat, the short-term interest rate target to 0.75. And as we speak, the dollar yen has paid gains slightly after the BOJ decision. That's an interesting situation. We'll be watching that. The yen is expected to get stronger. Real interest rates are expected to remain at significantly low levels, is what the Bank of Japan has also commented. Additionally, saying that the economy has recovered only moderately, although some weakness is seen. The BOJ says that they will continue to raise the policy rate if the economy and the prices move in line with forecast, in accordance with improvements in economy and prices. Also adding that we will conduct monetary policy as appropriate from perspective of sustainably, stably achieving that 2% inflation target. That's the key that they are watching out for. Remember, it was this morning at 2.9%, 3% was core. And the Bank of Japan also saying that wage and inflation is likely continuing to continue to rise moderately in tandem. That's what they said. Now, the Japan market, the Nikkei, the share average futures have paired just a bit. They've risen slightly after the BOJ rate decision. It was last up 0.8%. We're also seeing the Bank of Japan saying that labor market conditions have continued to be tight. Corporate profits, they say, to remain at high levels on the whole. That's an indication again. And Japan's economic growth is likely to be moderate, the Bank of Japan says. Now, even after the rate change, the Bank of Japan adds that real interest rates remain deeply negative. That's what they say. The likelihood of realizing the baseline scenario has been rising, they add. And considering such factors as labor and management on spring wage talks, it's highly likely, they say, the Bank of Japan, that firms will continue to raise their wages steadily in the next year. That's an interesting development. How that impacts inflation is going to be watched. BOJ also saying, even after the rate change, the monetary environment remains accommodative and supportive of the economy. The Bank of Japan also saying that while uncertainties remain over the U.S. economy and impact of trade policy, these uncertainties have declined. How much they've declined, that's not indicated, but that's an interesting development. Globally also, you're seeing a little bit of that happening, that the scare over the trade policies have changed. That's the latest that we're getting. We're going to continue to follow what's being said, what comments are coming in. Governor Kazuo Ueda is there, Bank of Japan speaking, but let's just continue what we were discussing earlier. It's a busy week for central banks overnight. The Bank of England also delivering a 25 basis point Christmas cut. It's a 25 basis point rate hike for Japan, and this is in its last monetary policy from the bank. And move of the year, the move was widely expected and comes after a recent decline in inflation that outpaced expectations. CNBC's Karen So has more.
It's a pre-Christmas interest rate cut from the BOE. The bank rate lowered from 4% to 3.75%, the sixth cut in this rate cycle. Crucially, who voted for lower rates has impacted the markets. Governor Andrew Bailey tipped the balance, throwing his weight behind a reduction as expected, with a total of 5 MPC members voting for a move, while 4 dissented. The market was debating the potential for 6 members to support a cut, which would have sent a dovish signal. Sterling rose immediately in the wake of the decision, viewed as a hawkish cut. Governor Bailey pointing to limited space now for reductions as the bank rate nears neutral. Lower inflation this week of 3.2%, a new BOE forecast for economic stagnation impacted today's decision. But holdouts on the MPC remain concerned about sticky inflation, still the highest of G7 economies. Meanwhile, unemployment hit 5.1% this week, but the BOE said it did not see evidence of rapid slack appearing in the labour market. Karen Cho in London, the CNBC.
It wasn't just England that we were watching. It was a busy time for banks all across. The European Central Bank, though, pressing the pause button, leaving rates unchanged and hiking its growth outlook for the Eurozone for 2026 and beyond. CNBC's Annette Weisbach has the details.
as expected, the ECB did actually lift their growth perspective for the euro area for this year and next year. Also, they adjusted their inflation outlook. That was pretty much expected because the euro area economy is doing better than previously expected. But she didn't want to comment on recent remarks from Isabel Schnabel, who is sitting in the executive board, that the next rate move might actually be a rate hike because the uncertainties are higher than before. The better than expected performance of the euro area can also drive prices higher when it comes to service price inflation. That's a major concern for the ECB. On the downside, there can also be downside risks for inflation for next year. So that's why they are staying put and they monitor the situation. They keep on saying they're data dependent, they are in a good place right now, and they continue to be in a good place. And of course, a new assessment will come in February when a new round of staff projection will be published, and they also look more into what the changes of the economic system, especially when it comes to AI, will mean for the euro area and will mean also for price development and growth development here on the continent. This is Annette Weisbach for CNBC International.
Well, as we head into a break, we leave you with a look at the broader forex space. It's developing after the BOJ's decision to go ahead and increase its rate from 0.5 to 0.75 as was expected. So perhaps this was all priced in. But take a look at what's going on out there. You're seeing the US dollar at 98.47, the euro to the USD 1.17 muted, GBP to USD at 1.3376. But look at USD Japan. 156.07. The yen is what we're watching very closely. We'll be back with more. Welcome back. We're watching what's happening in Japan. Japan markets are just coming online after the lunch break. Yes, that lunch break is always interesting. Just minutes ago, we heard from the Bank of Japan. They've raised their rates for the second time this year. They did it in January, and then they didn't do it. And now they have done it at 0.75%. The policy rate is now at its highest level in 3 decades, 30 years. The Nikkei 225 up 1.47%, inching closer to that 50,000 that we saw earlier around the time of the administration change with Sanaya Takaichi coming in, and it hovered around 52 also. But take a look at what's the latest that we are hearing from the BOJ, the commentary coming in right after the decision. The BOJ is saying that they must be vigilant to risk including FX market developments, overseas developments, corporate wage, price setting behavior. And this is really the big conversation that we're having, the unwind of the yen carry trade, how this decision plays into everything that's happening globally, what will happen with US treasuries. Those are the big questions that we're trying to answer. Also, the BOJ is saying that consumer inflation likely to fall below 2% towards the first half of the next fiscal year and then rise thereafter. Remember, this decision was more or less priced in. 95% chance, 86% chance, depending on who you ask, that this was going to be raised to 0.75%. That's exactly what's happened. Remember, the first time since 30 years. We're also considering a couple of different things, that Japan has more inflation than the US for the first time since, the 1970s. The key question is going to be around the differential, right, between the US and other places and, of course, Japan. Will it be significant enough for those carry trade, the unwinding of the yen carry trade, the normalization, so-called, of Japan? Remember, Japan is amongst the largest foreign buyers, and this no more zero rate like they did for 20 years is really changing the entire global development very quickly. Just recapping for you what has been said. The BOJ is saying Japan's economy recovering moderately, albeit with some weakness. We have Martin Schulz joining us now. He's the chief policy economist at Fujitsu. Martin, this is the first rate hike since January, and thank you for joining us as this breaking news comes in. This was expected. Now, the question out here is this a slow start of hiking done over months, or can we expect a surprise, a further surprise of something happening much sooner?
Mm-hmm. Well, I wouldn't expect another surprise. This is Japan. This was well prepared. And the most important point for the Bank of Japan was, well, it was under heavy pressure to keep the domestic economy rolling. But now the government has been gunned into the market with huge fiscal programs. This provided some policy space to the Bank of Japan. They wanted to normalize interest rates, which are still so very low, over the longer term. And they saw, okay, this is the situation. They prepared it. As you have seen, the markets are very calm. So this is a planned one. I wouldn't expect too much action before next summer again. Important move to keep the Japanese yen stable, not dropping so much as it has been before. Very important move for industry here as well.
Okay, let me just unpack this a little bit for the context. Keeping in mind the Takaichi administration, the BOJ tightening that monetary policy, all of this happening while the Takaichi administration is pushing for looser fiscal policy, even though it's pushing for that looser fiscal policy just a little bit less in the last couple of days. So far, the market seems to be saying that the latter will outweigh the former, all right? And hence the yen is, well, weakening. This decision is expected to help the yen strengthen. But would you agree, or do you think at some point this tighter monetary policy will outweigh loose fiscal policy and lead to that stronger yen?
This is, I mean, the Bank of Japan now has, well, a lot of levers to go, because the government say, okay, well, you work what you have to do. We know that the Japanese yen shouldn't get much lower. We know it needs to stabilize, ideally becoming a bit stronger. We are supporting the economy domestically with fiscal instruments. You go into the market and show that, in particular, compared to the easing trend and pressure in the US, that you are on the way of, well, a bit more tightening, perhaps even higher interest rates if necessary. So I would expect that the Bank of Japan is focusing quite a bit more on the yen-dollar rate and saying, okay, well, 150 or something might be our target where we are going, and keeping, well, their policy in line with investor expectations for keeping the economy, well, from an external view, strong as well.
Okay, but are we approaching a level that Japanese domestic institutional investors will pull back from the yen carry trade?
Well, the carry trade is a tricky issue, which depends so much on expectations. And you have seen how much expectations are in flux on the US side, in particular right now, and on the Japan side. On the Japan side, you only need to have expectations stable. What we have seen with longer term rates is that they have been approaching 2%, also a record high for ages, 2% at the 10-year bonds, even higher at the longer end. So the bigger question would be if Japanese investors saying, okay, these are rates that are acceptable for us to pull some of our overseas investment back. I wouldn't expect a major wave here, but clearly for domestic investors, it gets more attractive to go into the market. But don't forget inflation on this calculation. Real interest rates are still deeply negative, which supports the government, but not domestic investors so much.
Okay, fascinating. You talked about the regulatory levers that were available as an option for the Japanese authorities to actually use. I want to understand more about what you think they will actually use. And I give you the example, for instance, of restricting NISA, the Nippon Individual Savings Accounts, to only invest in Japanese assets, or really forcing these Japanese pension funds to increase their domestic allocations to more than the current 50%. Is that something you see happening, or do you see something else happening?
Yes, Japanese assets, in particular stocks, need to remain attractive. They have been tremendously attractive. We have a boom in the real estate market where investment is heavily going on. Domestic investors need to be convinced that, well, overseas investment in the US has become way more risky than it was before, and that this economy is performing well. This is why I'm less concerned about, well, the risks to government debt or what the government is doing. The bigger question is what's happening in the domestic economy. And the Bank of Japan, with getting interest rates slightly higher, making it, well, a little bit more important for companies to go into mergers and into acquisitions, to boost productivity, to boost profitability, is supporting the market from a little bit tightening side, while the government is coming in and saying, okay, well, we help you with somewhat with AI, with future investments, going into national security spending and the military technologies that are relevant, investing into energy grids and so on. This should help the economy quite significantly.
It's very interesting that the BOJ has said something about what you just commented, and they've said that while uncertainties remain over the US economy and the impact of trade policy, those uncertainties have declined. Is that a fair conclusion? I know this is the BOJ's conclusion, so who are we to speculate? But at the end of the day, it's Donald Trump's administration.
Yes, absolutely. But I mean, 2025 was really this enormous policy mess that companies were confronted by. And they have been, well, quite a bit pushed back, being very concerned what to do. Japan now has more or less stabilized the tariffs about 15%, more around 10% in terms of what the significant impact would be. That means we have quite a bit more confidence here. We see that the US economy is slowing, but there will be significant investment into infrastructure, also by these huge packages the US government has pushed Japan into. Industry is focusing on technology that helps them to bring down costs, and we see this is working. Plus, getting the domestic economy moving. Manufacturers are still concerned about the outlook, but they need to invest, and they invest now into AI, into technology. The domestic service economy is doing very well. For them, AI, having all these robots rushing around in restaurants, in the logistics supply chains, making them more efficient, is a boon, and they can pass on prices as well, meaning profitability is up. So this is a quite positive outlook that we are seeing after a very, very difficult 2025.
Okay, I'm going to ask you to present us what I like to call in other words, all right? Break this down for us, because the BOJ is saying we will continue to raise policy rate, and the condition is if economy prices move in line with forecast in accordance with improvements in economy and prices. In other words, what does this mean?
Ignore it. the inflation rate has been way above the target of the Bank of Japan. They were just waiting out because they wanted to support the economy. Now they say, okay, well, this is what the government, the Ministry of Finance is doing. We can look at the other indicators that are important. Inflation is up. It's higher than expected. It is driven by high import prices as well. So the Bank of Japan is concerned about it. They will comment about it. They will be quite a bit more hawkish about it. And they will raise interest rates if necessary from an inflation rate. I wouldn't be too concerned about that, but their focus will be the exchange rate. When you see that the Japanese yen turns much weaker again, you can expect that the Bank of Japan is moving in. Perhaps the Ministry of Finance signaling only by some interventions, which then need to be backed up by higher interest rate. So I wouldn't be too concerned that the yen is driving down, but have an eye on it. And this gives you probably the best guide to what the Bank of Japan will do throughout the next year.
What about the fact that you have an administration that doesn't want to do what the Bank of Japan is thinking of doing? And I want to talk about the yen's rapid weakening. It rekindled those concerns about rising import prices also that I want to factor into this conversation. The government had little choice, you and I have discussed this, but to back this kind of a rate hike to stem the yen's depreciation. But for how long does this keep going when they want stimulus?
Yeah. I mean, the stimulus is huge. We have a supplementary budget, and now the Prime Minister has enough support to say, okay, we do not only need these additional supplementary budgets, we need to have a bigger budget. That will be decided next week, a bigger budget overall. So the government is really heavy in the economy, supporting it by spending that is going on a level of 2.5% of the overall economy. Having the economy growing at around 1% should be quite possible on that level. And this means that the overall balance seems to be, at least for next year, quite okay. What investors should be looking at, and those who are looking at the longer term economy, is what's happening with productivity. If technology is really applied, look at the companies who are doing that well. Others will be in trouble with higher interest rates. They will be in trouble with less positive financing conditions. So we will see a lot of M&A activities, weaker companies saying, okay, well, that's it for us. Bigger, probably more profitable companies buying them up. So we will have a very dynamic market domestically here.
Right. So we're seeing the Nikkei 225 rising, but we're also seeing the yen weakening. That's also what's happening. And we're watching the JGBs also. You talked about technology, so I have to ask this question. We were discussing this on Squawk Box earlier. Will the Japanese repatriate money back to Japan because of these higher yields? But as long as the AI boom in the US doesn't change and it continues, why would they sell? Why would they bring back money to Japan unless, say, the JGB yields go to like 5%? What's your take?
I don't expect too much on that side. The US economy is attractive. We have this huge $550 billion investment fund going in, which is creating infrastructure, import demand on the US and export from the US. So this is still an economy where Japanese investors are very optimistic. It's just a gradual change. So I wouldn't expect a much pullback. I wouldn't expect a boom in terms of the Japanese yen coming out of that. But I would expect that we have a stabilization here, and that is the current interest of the government and where also industry interests are. They just want to invest the cash they have, which is very expensive now because of inflation. They want to invest this in the best possible portfolio. The US is overpriced on many levels in technology. Japan is not. And these are where we are seeing that investors saying, okay, that makes sense. That works. This is where the profitability is going, and the domestic economy is an important part of that. It hasn't been during the last year, where investors were just looking at the US over so many years already. So we are seeing a more normalization with the US being overpriced for very long, and now we see where the portfolios are working in Asia.
Okay, so you talked about the U.S. and we've seen what the BOJ has just said in our flashes. The tariff uncertainty remains, but has declined. There are other uncertainties. There's been a shutdown there. Therefore, there's data uncertainty, and every central bank makes decisions based on data. And I want to just go to yesterday's U.S. inflation numbers and some of the reports that came out from analysts titled those inflation numbers from the Trump administration as the following: lost in translation from TD Securities, delayed and patchy per William Blair, and Swiss cheese CPI report from EY Parthenon. I just want to understand how this plays into central bank thinking.
Well, the US economy is slowing on many levels. This brings down inflation. Japan is being pumped up in the current situation. This keeps inflation on a rather high level. And when you look at what central banks can be doing, it means that, in particular with the additional pressure from the government on the US side, we will probably see that US rates are coming down further, while Japanese rates have been just raised and are at the edge of when it's necessary or possible to increase them further. That should help. Interesting would be to look at the euro yen rate, which sees that the yen is undervalued. This is historically terrible, and you see that the weakness in the yen is still there. It is still very strong, and we shouldn't expect by current policy trajectories that this is changing too much. I would more expect a stabilization towards the US dollar. Overall, the yen remains very weak, attracting many for the opportunities that are here.
Sorry, very quickly, where do you see the yen headed now? What level?
I would expect that the longer term support around 150 for next year can be reached. I wouldn't expect too big movements right now, getting it much stronger very fast. People are still sorting out where they are putting their longer term money, and this will be the job for 2026.
Okay, we're watching one more thing, whether the BOJ can proceed with this kind of normalization without friction with the government. And remember, there's a big development coming up next year in May. 2 board members of the BOJ will be retiring, and it's understood that those who come in would be much more dovish. That could shift the balance. We also don't have clarity yet, and remember, we're watching the press conference that's going to come of Governor Kazuo Ueda, whether there's going to be any statement, unlikely, but will there be a statement around the neutral rate? That's the key question. All right, Martin Schulz from Fujitsu, thanks so much for jumping in at this time with all this breaking news developments coming in from Japan. We're taking a short break. We'll be back in 2 minutes. Don't go anywhere. Welcome back. It's about 3 minutes since the Indian markets have been trading. The Nifty 50 is, jumping up closer to that 26,000 mark. It was expected. GIFT Nifty futures did suggest that this would happen, up about 0.41%, 0.4%. But what is the news? The news is the dollar-Indian rupee relationship, the rupee strengthening and going below 90. That's going to be something that we're going to have to dive a little deeper into. There have been interventions that have not been officially confirmed, of course, but traders suggesting that the central bank in India has been intervening. At this point in time, 89.99, it was just 89.90. We're watching those developments. We're watching a couple of IPOs also. The ICICI Prudential AMC, that's a big IPO that the Indian market will be digesting today. A lot of money is expected to go into that. It's day one of trading. So there you can see some impact with Nifty 50. Of course, Japan's development, wherein the central bank going ahead and increasing its rate to 0.75 was probably priced in. But the Indian market will also digest the fact that it's actually officially happened now. We're also watching Indigo, the Indian airline, the budget airline, now being reviewed over allegations of violating antitrust laws. It currently controls more than 60% of India's domestic travel market, and its India competition watchdog is really now assessing complaints accusing Indigo of abusing that dominant market position, including claims that the airline cancelled flights only to resell them at much higher prices. It is the latest blow to the airline after its unbelievable crisis earlier this month, when about 4,500 flights were cancelled amid crew planning failures, and the shares of Interglobe, the parent company of Indigo, up about 0.53%. But this news will trickle down, and we'll see that play out through the day in the Indian market. But staying in the airline space, if you regularly fly around Asia, chances are you've actually eaten food prepared by SATs. That's right. Now we'll explain what that is. CNBC's travel and logistics reporter Monica Petrelli got a rare look behind the scenes for this week's episode of CNBC On Assignment. And Monica is right here with me in studio. Besides making me feel hungry with the food that she's going to show, tell us, what's this about?
When you fly, do you ever wonder about where the meals come from?
Always. Well, actually, when the food is there, I don't care. But before that, yes.
I do. And, I think about what I thought then and what I know now since doing this report. And really, not only are the size of the facilities just so much bigger than I ever thought, but the sheer volume of food being made. And that's both in terms of the meals. So SATS produces 300,000 meals per day. Most of that for airlines like Singapore Airlines, it was once a subsidiary of, but also the production facilities here in Singapore, but also in China, in Japan, and India. Now, there's a few reasons for that. One, you can reduce costs that way, but also the local market, typically the expert, it makes sense that the production facility in India knows a thing or two about Indian food, but also you don't have very much time once you make the food to get it on the plane and to serve it through a method called cook chill. So this is one of the things that we examine in this long report that we're going to be bringing to you this weekend, but I want to give you a little behind the scenes sneak peek right now. Take a look.
Few get to go inside SATS kitchens to get a first-hand look at how in-flight meals are made, which is where we headed next. But first, we masked up and covered up from head to toe before washing and sanitizing our hands and even taking an air shower. In the kitchens, automation is the name of the game. Take rice, for example, a staple in Asian cuisine. With the touch of a button, an automated rice line gets the job done. The rice is dispensed, washed, and certain types are soaked. Water is then measured and poured into individual pots. Once the rice is cooked, a robotic arm removes the lid. The pot flips, and a spindle fluffs the rice to prevent clumping. Staff place the rice on a tray before it's blast chilled. This production line makes around 600 kilograms of rice in an hour, which is enough to feed around 5,000 passengers or 14 full A350 wide-body jets. Meat is prepped with the help of automation too. Up to 150 kilograms of meat can be dropped into these tumblers, which use pressure to infuse herbs and spices into chicken, lamb, and beef. The process tenderizes the meat and reduces marination time.
Instead of marinating overnight, we're able to marinate the process in about under an hour.
When it comes to mainstays like fried rice and noodles,
in 2019, we introduced what we call the auto fryer.
Staff simply throw in the ingredients, oil, seasoning, rice, and vegetables. And a spindle stirs the food as it fries. Cooking time is cut in half and physical labor by even more. SATS also analyzes food for texture, color, viscosity, and acidity, plus sugar and salt levels. Even the common bread roll is put to the test.
This is testing the softness of the bread roll. So if we need to improve the fluffiness and the softness of the bread rolls, we will have an objective measure.
But not all processes can be done by machines. Humans are indispensable in SATS kitchens. They prepare food, from slicing beef to making omelets, from plating meals to wrapping trays, all while maintaining strict food safety standards along the way. And for some dishes, technology gives way to tradition, like grilling satay, hawker style. SATS makes around 14,000 sticks every day. Once cooked, meals are put in a chiller and must be consumed within 24 to 72 hours. Frozen food, however, lasts much longer. But does it taste as good? According to SATS, passengers can't tell the difference.
Frankly, if I don't tell you it's frozen, you wouldn't know it's frozen. The technology has improved to this extent where with the technology, with the culinary expertise that we have, we can make great tasting food that's nutritious. At the same time, it looks great as well.
So for more of that special deep dive into SATS, you can catch the full CNBC On Assignment episode this weekend at the timings shown here on your screen. Back to you, Amitoj.
Well, thanks so much, Monica. Appreciate that deep dive. I'm going to be watching this on the weekend, not only because I'm already hungry, but because that's great reporting. Appreciate that. Now, that's all the time we have today on Inside India. You've got to keep watching because we've got something coming up on the other side, and that's Access Middle East. And we have a special update around an Indian IPO. So watch that for sure.